Good morning, good afternoon, good evening, everyone, and welcome to Demystifying Raising Capital from Angels. My name is Michelle Eisenberg, and I am a program assistant at the NASDAQ Entrepreneurial Center. And for those of you who may not know, the NASDAQ Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. So as you will see in the chat in a moment, the NASDAQ Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So definitely make sure to check out those links and resources in the chat. And then just a couple of housekeeping items before we get started. First, let us know where you're dialing in from in the chat. And second, we're going to open up for live Q&A at the end of the event. So please make sure to submit your questions for us in the Q&A function at the bottom of your screen. And we will try our best to get to all of them. Awesome. Texas, LA, Florida, New York, UAE, Santa Barbara, Florida, Massachusetts, Minnesota. Welcome, everyone, all across the board. We love it. All right. And of course, none of what we do could be possible at the center without all of the amazing support from our sponsors, including NASDAQ, Lehigh University, Bank of the West, Airbnb, KPMG, Wilson Sonsini, Woodruff Sawyer, Microsoft Entrepreneurship for Positive Impact, BPM, and HubSpot for Startups. We are humbled by their contributions and hope you are grateful too. And so before we get started, we always like to launch a couple polls and see how everyone's doing today. So I'm going to launch this first poll. How are you feeling? Fearful, anxious, surviving, or optimistic? Give it a few moments to give everyone a chance to respond. Thank you for participating. All right, I'm going to end this poll and share the results. Optimism in the lead. We always love to see that, but definitely emotions all across the board. So I'm very confident our conversation today will address some of those feelings. So I'm going to stop sharing this poll. And I'm going to launch that second poll. What is keeping you up at night? And this one will tell us a little bit more about your current entrepreneurial needs, so we can take that into account for future programming. Awesome. Thank you for participating. Give it another moment or two. All right, I'm going to end this poll and share these results. Finance well in the lead, very fitting for our conversation today, but I do see some indications all across the board, so we will take that into account as we move forward with programming. All right, I'm going to stop sharing this poll, and without any further delay, please join me in giving the warmest welcome to Margaret Batchelor, the Educational Initiatives Director at Angel Capital Association. Margaret, thank you for joining us, and I'm going to hand it over to you.
All right, thank you so much, Michelle. We're so grateful to be here today. Greetings, good day, everyone from the Angel Capital Association. I'm Margaret Batchelor, and I'm with our director of our program as Director of Education. If you haven't heard of us here at the Angel Capital Association, we are the world's largest society of active and accredited angel investors. We have over 250 angel groups all over the country, 15,000 members, and our members are deeply passionate about finding great companies. So we know that you're all very excited to learn about what we have. Our association has some education, analytics, and advocacy on behalf of the startup community around the country. You certainly have my information in LinkedIn, and we'll send you some information later to keep connecting with us. But I just want to certainly hand it over to our amazing host and panel today. We have some of our Angel Capital Association members who want to go and explain to you and kind of give you the peek behind the curtain of how to raise capital from angels and the best way to position yourself for the fundraising process. So I'm going to, without further ado, introduce Les Schmidt, but I'll certainly be keeping an eye on the chat and hope to connect with everyone either by LinkedIn or via email in the future. So Les, take it away.
Thanks, Margaret. Great to be here with everyone today. And I wanted to, I'll first introduce myself, and then I'll let the panelists actually introduce themselves as well. So I come to Angel Capital by way of 7 different startups, 2 IPOs, a bankruptcy, and some other experiences as an entrepreneur. So I have a very different perspective about Angel Capital, and most of it is something that all of you will experience. So I share the journey of the founder, but at the same time, knowing the mindset and knowing how Angel capitalists actually look at your company and evaluate whether or not to make an investment. That knowledge, I wish I knew when I was an entrepreneur early on. And so I'm delighted to be here today to help demystify that for you on your journey and hopefully lead to a productive conversation with angel investors and really get the capital you need to go forward. So let me get the angel investors that you're going to be hearing from today introduced, and we'll get going. So first off, Brittni, you want to introduce yourself? Camera on. There we go. There she is.
Hey everyone, my name is Brittni Abiolu. I'm the founder and managing director of VentureHue, which is a venture studio where we accelerate and incubate our own business ideas. We also do some angel investing. I just started angel investing in the last 2 years, but I've been working as a startup consultant for 17 years, helping startups with different things like web development, digital marketing, and advertising. And more recently, like I said, I got into angel investing in the last several years, and I've done about 7 investments so far.
Excellent. Great. Next up is Alex.
Good morning, everyone. So I'm Alex Muromcew. I spent my career on Wall Street as an institutional portfolio manager running mutual funds and pension funds, and started angel investing about 10 years ago. And it was sort of a natural transition going from, I'll call them mature companies. They're listed on a stock exchange. You get your nice GAAP earnings and audited financials and the annual report, and going and dealing with startups where it's very much you're in the trenches and hopefully adding some value, not only by providing funding, but really being there with them as a mentor and advisor. And now I am a partner at the recently formed Rockies, Wyoming Fund.
And Alex, and I'll come back to Brittni as well. Give an example of what's a typical investment that you might make.
So we have a very strong entrepreneurial ecosystem here in Northwest Wyoming, where I'm based. So very often I'm investing in companies where I'm very familiar with the founders. And, clearly at the end of the day, you are investing with that founding team. And so that's a very important kind of subjective element to any investment. And
any particular kind of company?
I've invested in social media, outdoor recreation, enterprise SaaS. It's quite varied up here.
Okay.
But I will add that I often, for more technical areas such as biotech and some technology, will go in through funds where I just don't have the expertise to properly evaluate. Or if there's a really strong team who's syndicating the deal and I have faith in them, then I'll participate.
Great. And Brittni, how about you? What's a prototypical example of an investment you might make?
I would say I'm pretty much industry agnostic, but I focused on that pre-seed and seed stage and really on underrepresented founders and overlooked founders that may be having a hard time raising at the earliest stages, especially women and people of color, and then other overlooked founders as well.
Okay, awesome. All right, with that, I'm going to introduce our third panelist, Yaniv.
Hi, thank you for the introduction. My name is Yaniv Sneor. I'm the founder of Mid-Atlantic BioAngels. We are a life science angel investor group. We invest exclusively in therapeutics, devices, some diagnostics, and digital health. And we invest all over the world. And we invest as individuals. We have internal pools or funds that we call pools. And to Alex's point, we have funds for people who want to participate in our investments. We're not experts in the life sciences, but who want to invest alongside the expertise. So
Great.
That's who we are.
All right. Awesome. All right. Well, let's get into the webinar topics that we're going to cover today. We're going to start with kind of looking at some real basics, which is when angels invest, that is when in the life cycle of a startup do they invest, what risks they're willing to take and not take as they look at prospective investments. And then we're going to get into some things that are really the things that are more difficult for founders to assess, which is what are the expectations? If I take an investment from an angel investor, how will my company be different, and what should I expect them to expect of me as I go forward? And we'll look at some of the characteristics of startups that angel investors are typically looking for. And then we're going to open up for questions at the end, and certainly lead you to resources where you can learn more as we go through the webinar here. But one of the things I want to say right up front is, as you've seen from the four, including myself, angel investors that are in this webinar, angel investors are all different. They all come to angel investing from different walks of life, from different perspectives. They have different focuses in terms of where their money, where they want to put their money, where they see opportunity. And one of the challenges for founders is to make sure that when you start to raise angel funds, that you actually do the homework to find the angel investors that are most likely to be interested in an investment in your fund. All angel investors are not alike, and they don't want to waste their time talking to you if you're not a good fit, and you probably don't want to waste your time if they're not going to say ultimately that it's not a good fit and not an investment for them. So really kind of take into account that what we're going to talk about today is typical, but every angel investor is a little bit different, and you got to do some homework to really figure that out. In general, there are, however, some principles that are helpful when you're thinking about raising angel capital. The first is the perception about timing. Now, lots of founders I've heard say, oh, I'm going to go get some angel investors to invest in my company so I can build my product. And typically, that is not the case. Angel investors are not investing in building projects. They're interested in investing in companies that they can get a return from down the road. And typically, angel investors are not the first money in. That typically comes from friends and family and some other sources that we're going to talk about. So the reality is that angel investors are the first outside money in. Some say the first professional investment that you will receive in your company, and that's where to think about them in the course of maturing and growing your startup. Now, we've all heard of the different sort of parts of the journey, different stages of the journey of a startup, from having the initial idea all the way up to, okay, now I got customers and now I just need capital to scale my business. Those are kind of the two extremes of the scale that we're going to talk about today, because after that, then it's kind of IPO money and more intense funding. And these roughly coordinate with the funding stage that we all hear about. We hear about bootstrapping, we hear about seed funding, seed plus or series A or seed alphabet soup. But those funding stages are less tied to the actual startup stage than you might think. They do have some association, but they're really just loose associations. And you shouldn't kind of say, well, if I'm here, then I should be able to get this kind of funding, because there's always nuances in the details. So then the question becomes, where do you get funding from? Where are the sources that fund each of these stages of growth along the way? And if we look at the earliest stages, we're looking at stages that are, or funding sources that are not outside capital. They're looking at founder funds, they're looking at friends and family, and then more recently, equity crowdfunding may be an opportunity because there are some requirements that allow you to actually raise up to $5 million through equity crowdfunding. Maybe that's the first funding that you go after. But angel capital typically is coming in the pre-seed, as I think Brittni identified, pre-seed to seed, and maybe a little bit beyond the seed stage in terms of follow-on funding. But this area where the company is at the proof of concept, ready to actually develop the product robustly, engage customers, get into customer trials, et cetera, is a typical stage for angel investors to be involved. After that, there are other things, other sources of funds, which are typically more formal funds, VCs, private equity, corporate venture funds, et cetera. So angels really sit in the middle, the first professional funding after your friends and family. But what do angels look for when they start to evaluate your company? Well, at the earliest stages, the parts of your company that are probably the most advanced are your product and your team. And this is just a simple graphic we're going to use here to illustrate a few points along 8 different dimensions of your company. So you're developing your product, you're developing your team, but revenue isn't something that happens at the earliest stages because you don't even have the product yet in order to generate revenue. You don't have customers, you don't have a sales pipeline. You're early on working on your fundraising, your pitch, your deck. But maybe not doing much in the way of marketing systems or building other kinds of fundamental things that are important to maturing a business. But when you get to a certain point and your company looks like it's like this, where all of those different dimensions are more advanced, now you're actually a much more attractive company to an angel investor. Now, it never happens that they're all dimensions are at the same point at the same time, but roughly speaking, there's a level of maturity of a company that is attractive to a particular kind of investor. Here is one of the places where there's a big difference. So if you're a tech company going after angel investors to invest in software or social media or consumer e-commerce platforms or those sorts of things, this kind of stage view might be appropriate. As Yaniv will talk about later, in life sciences, the stages are a little different. But there is a perspective of angel investors that invest in life sciences that there are certain requirements for the company to be ready for an angel investment. So our first panelist questions actually revolve around this. And I'm going to open it up to the panelists. The first question is, in the last investments that you made, what did you feel was the aspect of the company that was most developed? So thinking about those 8 different dimensions, what parts were most developed when you made the investment, and what were the least developed? And Yaniv, I'm going to start with you just to kind of have that difference between the tech investor and life sciences investor kind of first at hand here.
Thanks, even though I think we're actually on this part, we may be very similar, but one thing that's the most important for us is the strength of the management team. As angel investors, we all have day jobs, and we're not interested, nor do we have the bandwidth to jump in and to run somebody else's company. And so we have to feel comfortable enough that the people who are running that company know how to monetize, how to take the product from this stage and bring it all the way to an exit. And so in case of, therapeutic companies that we invest in, for instance, or drugs, as other folks would know it, there'll never be a sale that this company will ever experience. They'll never sell a single product in the marketplace. And so every company in that domain is pre-revenue, which is very different for all these tech companies that we'll be talking about later on. But the number one and the aspect, as you asked, that we were looking for was the development of that management team. We have to feel comfortable that if we give them our money, they will know what to do with it and how to bring us all beyond the finish line.
Perfect. Brittni, how about you?
Yes, the team, I would say, and the product was the most developed. They're in the pre-seed stage. The least developed, I would say, they have users, but it's still, they're still building that traction, that momentum, their revenue. They're very, very early. So I would say definitely the team, that's what I look at the most, and the idea, and also the product was the most developed. It's just that they don't have a huge user base yet. They're still in those earlier stages.
Okay, great. Alex, how about you?
Sorry to sound like a broken record, but it's the team. Because starting a startup is really hard work. It takes perseverance, endurance, grit, and you need a team that has depth where different people have different strengths and skills. So you really need that well-rounded team.
Great.
And I'd say the area where I see least developed is the go-to-market strategy, understanding how to acquire customers, the cost of acquiring those customers, the lifetime value of a customer.
Okay, great. And so that's the least developed at the point that you make the investment.
Yes.
Yeah, great. So I think, team clearly comes across as a primary thing that angel investors are looking at this early stage, because there isn't a long track record of revenue or product or customer acquisition. So team is all that matters, and there's a number of dimensions. It's the completeness, as well as the domain expertise, as well as the making sure that the CEO understands what weaknesses they have and are in it for the long haul, and really has what it takes to kind of take the company to the finish line. So for the least developed item, the one, and Alex, we just talked about it, so I'm going to go back to you. What gave you comfort that would develop, and that was okay to make the investment even though that wasn't yet developed?
I feel that's a little bit later stage. I mean, if you don't have a strong team and if you don't have a great product, your go-to-market strategy is kind of irrelevant. And on one hand, with digital marketing, evolving so quickly, it's a challenging space to really stay on top of, but there are a lot of resources out there, or consultants, advisors who can help in that area.
Great. Brittni, how about you?
Well, my background is in marketing, and I've worked for marketing agencies. So the startup that I'm working with, my value add is I have access to strong marketing teams. So even though they have a small user base and they're in the earliest stages, I know that I have a team where we could assist them with their go-to-market strategy, and with them already kind of having product market fit because they have a user base and it's slowly growing and they have that revenue. I felt like the investment still made sense because I have that marketing team that can add that value and support them to really help them scale.
Fantastic. So you can fill in the gap, and not worried about the fact that the founder doesn't have that covered at the outset, right? Great.
Awesome.
And Yaniv, how about you?
Yeah, so perhaps I'll rename your question from least developed to the least predictive. Maybe that'll be more appropriate for us, because when you invest in life sciences, and we have to break it up because the investments are different whether you invest in a therapeutic, a drug, or whether you invest in a device or diagnostics or a digital health company, where there is going to be at some point some traction and some market feedback, et cetera, before the company sells. But especially in the cases of a therapeutic, we have to rely on models. We have to rely on, that somehow all these expectations for the drug to work will actually pan out in some way. So we hope that the models are predictive, but they are not in many diseases, unfortunately. We tend to joke that we cure a lot of mice, but not necessarily people. So we hope that the models we're using are correct. We hope that they are the most predictive. I had in a discussion with a big strategic one day, I asked them, what do you do when you don't have good enough models? And they say, it's like a crime scene. If you have enough different pieces out there that tell you that are predictive, or that tell you certain things should probably happen, most likely or hopefully that the chances are high that this will happen. So that's, for us, the least developed or the least predictive. And that's where we take sometimes the biggest chance. But we do want to see a strong management team. We do want to see a clear adoption phase of how this will be adopted, who will most likely buy it, what will the exit most likely look like, what are the steps that they're going to be needing to take from a commercial perspective. You know, what are the discussions with the FDA? What will be required in terms of clinical trials? Because all of these inform us in terms of the amount of money and time that's going to take between our investment and the exit, and which is very important for us to understand.
Great, great. And I think I know the answer to this, but maybe for our audience, how has the most important thing, which you all said was team, changed in light of current economic conditions? Yaniv? Yeah, go for it. Yeah.
It's the same. I mean, we still expect strong management. You know, we don't necessarily expect there to be a complete team, but if the team is not complete, we do expect to see what's the roadmap, because maybe you don't need all those different people right now. But I like to see that the person who has the understanding of the commercial path ahead is, for lack of a better term, driving the bus, right? And I do tell, if I see a startup with a CTO and a CEO, I tell them I want that CEO to win every argument, because the market has to drive the development of the product in the company and not the science.
Great, great. Alex, how about you? Things change?
You know, with the companies I'm dealing with, I haven't noticed a real change, but theoretically, there's a lot more talent out there that you can recruit from. And I think it also, in this environment with the layoffs from the big tech firms, that people now want to have more control over their destiny. And so they're more willing to be with a startup because in a sense, they're more in control than if they're with some gargantuan tech company in Silicon Valley.
Interesting. Okay. Brittni, how about you? Things changed?
I would say no, but I'm paying closer attention to traction overall and what the teams have been able to do on their own without an outside investment. So just looking at the perseverance and conviction of the team, you know, more.
Okay. All right. Great. Okay. So one of the things that is a dialogue that founders and angel investors will likely have is about risk. And in every startup, there are a number of risks. There's 8 of them listed here. I think if we take the time, we can probably make a list that's much longer than this. But there's always a balance between risky investment and foolish investment. And risky investment says, I know the risks, I understand them, and I'm willing to make the investment. And there's other risks which are too risky that an investment simply doesn't make sense. And that
All right, looks like Les froze there. See if we can get him back. But if anyone kind of like had any thoughts on that, to expand kind of.
Yeah, I think, Michelle, it's Margie. If you want to go to the next slide, I know we have another discussion segment coming up. So hopefully we can get Les back, but just kind of get some feedback from the team on the various risks that we're seeing there in terms of, you know, really kind of taking a look at there's risk. This is a high risk asset class. When you're looking at these different risks, just, you know, kind of feedback. Maybe we'll go Brittni, Alex, Yaniv on what you look for and how a founder can de-risk what they're working on.
Well, I definitely look at the size of the market, how fast it's growing, what other competitors are out there and what they're doing and or have done. Definitely looking into what can be done and if there is a really big need for it. That really better helps me understand the overall risk. And I would say that's the number one thing for me.
Great. I'll jump in. I'll say, obviously, look at competition. One, how fierce it is, but that also tells you a little bit about the size of the market. Obviously, market size. And then often what I'm looking for is disruptive technology, a new approach to an existing business model. that tends to be lower risk. And, for example, fintech is where you see a lot of that. For decades, there was very little evolution in consumer banking and consumer lending. And all of a sudden you could take technology and just leapfrog the entrenched competitors.
I assume you would like me to to weigh in. So we look at risk in different buckets. When you invest in a company, there are the risks that a life science company is going to have to address. Some of them are regulatory, obviously some of them are scientific, many of them are execution, IP. And so we list all of those buckets as we go into an investment and make sure that we look at them and that we evaluate them and until we get comfortable with all those different risks where we think the company is successful. Then there's another type of risk, which is a risk to our investment. Will we make money from this investment? That is another risk. Is not a risk to the company, it's a risk to us. One of those things could be how the company is governed, how it's managed, and also the amount of money that the company will require to reach an exit, because it may bring them into a different stratosphere of money, at which point, if they raise money, we would be diluted too heavily and not see a significant or meaningful return on our investment. So that's another area of risk that we need to address. But I think that ultimately, the way to de-risk these kind of investment is to invest as a group. Especially in areas that are complex. I don't think that any time it's possible for any one individual to think of all of the questions that you need to prod and to look at and all of the areas that you need to pursue. And so when it comes to risk as an investor, you want to make sure that you have a lot of other great investors with you, and you're working with a group with a bunch of people that you know and that you trust, and that they all bring different expertise to the table, and that you mitigate your risk as an investor by making sure that you look at in a objective way as much as possible, look at all the different aspects of the company and the investment before you commit.
And then there's always the risk that the power goes out in the middle of a very key presentation.
Well, Les, it's back to you. We just jumped ahead to the discussion to just keep the conversation going.
Fantastic. All right. So we were talking about risk. Did you cover risks? Yeah. So the brief point on this slide is that anytime you have risks in a startup, you also have the ability to offset those risks by working on things that you can control and things versus the things you can't control. So building a product that has a compelling reason to buy, making sure you're pursuing a huge market, that you have an efficient path to that market, and that you continue to build a high-performing team and use all of the resources to build attributes to your company that ultimately lead to the potential to have a high exit potential. So the discussion of risk is really about how can you as a founder take risks off the table to make it a more attractive investment for the investors that you're bringing in. So we had some questions here, and maybe this is where you got to. You got the discussions about the risk. Is that where you went?
Yeah. We kind of heard from everybody, which was great.
Okay, great. And balancing it. All right, great. So let's go to the next part then, which is kind of really thinking about how do angel investors think? Well, I think we've already exposed a number of different aspects, which is they think about your opportunity as a bucket of risk and a bucket of opportunity. And when they're in balance, or if the opportunity exceeds the risk, then they're more likely to invest. But they know, that their significant risk remains. And the questions are, the risks that do remain, are they within the startup's control, or are they things that are risk of the macro market? Well, if they're risks of the macro market, then the angel investor is going to be thinking, well, what do I think about those risks? And if I think that's a risk that can be navigated, if it should happen, and we've got the right management team to do it, then that won't be a barrier to making that investment. The other last thing, and we talked on the previous slide about high exit potential, is the timing for that exit. Because one of the rules of money is that time is money, and that doesn't mean that when you spend an hour and you get paid for it, that's time is money. That's true. But the longer it takes for a startup to actually have an exit event, that could be an IPO, could be a sale to another company, but the longer it takes, the more risk there is. And so if you have a company and there is a clear, shorter path to an exit opportunity, then your investment's going to be a more attractive investment for angel investors. Okay. And here's some other things that you can do. You can do in terms of making your startup a little less risky. First of all, when you go after customers, and particularly if you're in a B2B setting, if you're selling software or other services to a B2B, you want not just one customer. Lots of founders think, oh, I got my first customer, I'm ready for angel investor. Well, that's a data point of one. And in any experiment, you know that the next data point could be not one. And so angels want to see at least 10 and maybe more B2B customers before they'll say, oh, okay, there is market acceptance of your product. Now, you could have some proof of concepts, you could have some beta trials that help support that, but one customer does not de-risk the revenue aspect of building your company. If you have gaps on your team that are necessary at the particular stage you're at, and you've got, let's say you don't have a CTO, that your CTO just left, that's going to be a big gap that is going to be a place for concern for an angel investor. So closing that gap and then raising is a far better strategy. All right. And then really be sure, this last item is, I can't emphasize enough, is have a say-do ratio of 1. Now, what's a say-do ratio? If you've not heard that before, and that means that everything that you commit to your angel investor, to investors in general, is you actually do. If you say you're going to have the pitch deck to you by 5 o'clock on Friday, have it to them by 5 o'clock on Friday. If you say I can deliver, 3 customers by next week because we're just signing the contracts, then deliver the 3 customers. If you can't deliver those customers, then don't make that commitment, because anytime you sacrifice that say-do ratio, it builds a level of questioning and a decreased level of trust that is really, really important when you're working with an angel investor. Okay. Now, let's talk about the returns that angel investors expect. You've probably all heard that angels want a 10x return on their investment. Well, where does that come from? Well, this little funnel on the right-hand side, it will be a starter explanation of why 10x is really an important thing for investors to be looking at. First of all, in 10 investments, if an angel investor made 10 investments, this is how they would typically fall out. 4 of those would be strikeouts. They would go nowhere. The angel investor's capital would be washed away, gone. 2 of those would be bunts, using a baseball analogy, and the angel investor would get their money back, but no more. So they would have had money involved and wrapped up for a period of time, but made no return on that investment. The next level is maybe they got a double or a triple a return out of 3 or so of the startups in the 10, but typically only 1 actually achieves the 10x home run. And when that 1 achieves the 10x home run, it actually pays for the 6 that returned nothing, right? And so every investment that goes into the construction of a portfolio is usually expected to be a 10x, because no one knows which one will actually be the 10x return. But that's why angel investors are always looking for that outsized return to offset the risks that are involved in angel investing. Okay. And so there you may find, part of the point of this is, you may find when you have a conversation with an angel investor, they decide not to invest in your company. Why? because you don't meet the threshold. That could be one reason, or the other reason could be because they already have constructed a portfolio that they're happy with at the moment, and they don't have additional funds to invest. I think the key point here is that every investment needs to be a winner. The expectation of what that winner will be is a shared belief between the angel investor and between the founder. And if you both agree that it's a 10x investment, then you're way more likely to actually get an investment. So these are the returns that investors seek, and hopefully that explanation helps a little bit in explaining the portfolio construction. Now, where do you get a 10x investment return, right? So here are some places where investors are typically looking, that is the markets and industry sectors that they're typically looking at to get the outsized returns. They are technology related, in e-commerce, in green technology, financial technology, healthcare, biotech, et cetera. And they're always looking for approaches into those industries that create new opportunities. If founders come and say, I have a better thing, that is not necessarily going to interest an angel investor. Having something the market doesn't currently have, having a different thing, is much more interesting, as it's likely to be much more likely to lead to a disruptive and outsized return. All right, so panelists, how do you think about an investment in the context of the investments you've already made? What are the mechanics, or what thought process do you go through when you have an opportunity to invest in a new company, but you already have an existing portfolio? Alex?
Yeah, I want to start off with one point, sort of a reality check for the audience, is a lot of businesses, they may be great businesses, but they just aren't suitable for angel investing, because you're just, as an investor, I'm not going to get the great returns to offset the risks elsewhere in the portfolio. And so sometimes that's why I say no. It's love the business, but I'm not going to make enough to compensate for the risk.
Got it.
And again, angel investing is the riskiest possible investments I can make, because it could be 10 years before I can ever get any return on that money. My money is locked up for 10 years with zero return until there's an exit.
Okay.
The other relevant item is that if you are, let's say, a slower growing business, great business, if you want investors, you have to make sure that you price the company appropriately. Because I've also seen some businesses that, if they could scale up, would be great, private equity investments, good cash flow, good growth businesses. But if they're priced too expensively, again, you do the math and you're just not going to get a return to compensate for the risk.
Got it. Okay. Brittni, how about you?
Well, I think of it the same way that Alex does, but I also want to add that I also look at what kind of support the founder already has. Are they coming out of a popular accelerator like Techstars or Y Combinator or something like that? And do they have other backers, even if they're like in that pre-seed and seed stage? I look at their support system as well to see, do they have enough support to really go far and do this at scale and get that good return?
Great. Yaniv?
Yeah, I think every investment that comes across our desk, into the group gets reviewed on its own merits. They all go through the same diligence. They all go through the same process. And at the end of the day, we either decide to make the investment or not. But and as much as you'd think that one is similar to the other, I've never seen any one that was similar to any other.
So in your case, portfolio does not make a big difference.
It has not so far. No.
Okay, great. All right, so for each of you, can you share an example of a company that's in your portfolio that's disruptive, to this point of kind of looking for things that are outsized returns? Help us define a little bit, what does disruptive really mean in your world? And Brittni, I'm going to start with you this time.
Yeah, there's a company that I'm working with in the health tech space, and they're being disruptive in the health record space. there's like one major big player in that space. I think it's called Epic right now. So they would be really coming in and making a huge disruption in the industry. And they're kind of like the first to do it. So it's hard they need a lot of upfront capital. The founder has invested a lot of his own money. He just emailed me and said, I don't have any more savings. I put all my savings into this. I need to raise from outside investors. And it's just, he's in this weird area where it's kind of really hard for him to raise, but I feel like it's gonna happen. And then to contrast that, one that's not really disruptive, it's in the payment remittances space in Africa, actually, which fintech is like the most funded in Africa right now. And the payments remittances apps are popping up all over the place. There's like Chipper Cash and Flutterwave and Paystack, which is so many, it's kind of like the market is saturated. So it's not really disruptive, but people are still investing in that space because there's so much money to be made. So it's easier for them to raise capital, actually, because it's kind of already been solidified, but the other company is having a hard time because it's more disruptive, if that makes sense.
Okay, great. Great. And can you put your finger on what is it about the health tech, the medical records company that makes it disruptive? Is it a different business model? Is it different process? Is it what's the thing that makes it disruptive?
So the way the end user, you and I, would be able to retrieve our health records is different from what's available now. It's not being done that way now.
Okay. All right. So fundamentally different product altogether. Right. Okay, great. Alex, how about you?
Sure. For the disruptive company, I'll talk about a fintech firm that helps students finance trade school. So it's sort of an overlooked niche in the education market, but it's a very big market. And it's a product that's really needed to offer different financing alternatives for students.
Okay, great.
And then one that is not, I'm an investor in a company that makes high-end snow and off-road shovels. So it's not disruptive, but it is a multi-billion-dollar market.
Okay.
And as they put it, they're the Yeti of off-road shovels.
Okay. That's a new one. That's good. Yaniv, how about you?
So we have four main investment criteria. Everybody mentioned the first one, which is a strength of management team. Our second investment criteria is disruptive. So we're looking for things that will, in the way we define it, things that will change the standard of care, which will make people practice medicine a different way, is how we define disruptive. You look on the back end of it, you will see a broader IP portfolio. They own more IP real estate. IP is very important in our field. And so they're able to have more of that real estate because they are unique, they are different, they're differentiated. And so those are the kind of things that we look to invest in. But we would not invest in companies that are not disruptive. If they're just incrementally better, we would not invest in them.
Got it. Good. Okay. We've got one more slide, and then we're going to open it up for Q&A for everyone. And that is just a reminder that, when we think about being angels, one of the things that is actually a lot of fun is to become involved in the investments that we make. And because each person, everyone on this webinar, and probably most angels that you meet, have some expertise that will actually make your company stronger, better, navigate one aspect and develop one aspect of your company faster and smarter, because you've got the right capital sitting around the table with you, as opposed to just green money. Angel investors are not all alike, not only because of their background, but also because of what they value they can bring to you to accelerate the development of the company. And it's really important when you're thinking about getting an angel investment to evaluate how might this person really add to the overall outcome that we're trying to achieve here. So with that, we're going to go to Q&A, and I've got the question window open here. And one of the first questions is what's the typical size of an angel investment, and how much equity ownership are you expecting? And we'll start with Alex.
Well, I think there's a difference between what an individual angel might write, which could be 10,000 to 250,000 versus an angel group, particularly one that has a fund or is syndicating. Probably there it's, I would say maybe 250,000 or 100 to 250,000.
Okay.
And in terms of the equity ownership, 10 to 20%. But again, these are very soft targets. And particularly for, early stage, it's often easier to do a SAFE, although those are out of favor these days, or a convertible note, which doesn't price until you do a full-on equity round, because it can be very difficult to accurately price an early stage or barely revenue generating company.
Right. Which is why safes were invented in the first place. Yes. Brittni, how about you? What's typical? Investment?
Yeah, so right now I'm with several angel syndicates. So we're pooling our money together using platforms like AngelList. So in those groups, some of them I can invest as low as 1,000. The people can invest as low as 1,000. Some are minimum of 5,000 or 10,000. But I would say the average is probably, it just varies. Just like Alex said, it can go anywhere from, a complete raise from 150,000 to as much as 700,000 I've seen raised in one group for a company.
Okay. Yaniv, what's typical ownership and check size for you guys?
So usually our group would invest anywhere from $250,000 to $1 million per round. And we intend or expect to participate in all of the rounds until an exit. We prefer not to invest ahead of VCs. So we look for very specific companies in terms of the dollar requirements that they're going to need to reach an exit. And we often syndicate or either initiate the syndication or are part of a syndicate. And in life sciences, a typical syndicated round, and a round which means that multiple angel groups get involved in investing together, is usually anywhere around $5 or $6 million. I think the rule of thumb is that you usually give up between 20 and 40% of equity in a large angel round. We're not VCs, so we're not taking 51% of the companies, but that's the standard progression, so to speak.
All right. And while I've got you, we'll take the next question. What's the time range that you expect to get your money back?
We invest in companies where we hope to receive an investment return within 5 to 7 years. As you said, once things get beyond that time horizon, things get blurry. It's difficult to tell what the competition is going to look like, what's going to come down the pike. So we hope for 5 to 7 years. Sometimes it takes longer, and it's going to be great if it takes less.
Okay. All right. How about Alex or Brittni, time frame?
Time frame, I would say 3 to 7 years. 3 to 5 is ideal, but I know, I've even heard up to 10 years for some investments. But my preference is 3 to 5.
Yeah.
Yeah, I would say 5 to 10. Ideally shorter, but realistically 5 to 10.
Yeah, I think the longest I've heard is 10 to 20. And that's only if you're investing in something involving space exploration. Just because it takes so long to get it ready, to get it on the rocket, to send it out there, to get data, and then that's only your first product, and for it to really scale, it comes, many times after that. So there are industries where there are industry dynamics that are different, but most of the time, I think you heard it here. 3 to 5 ideal. 5 to 10 is probably the normal range here. Where would founders most likely meet the angel investors that would be appropriate to invest in their company? Any suggestions on how founders might go about courting angels? Brittni? Yeah.
I would say accelerators and incubators. Like here in Detroit, we have Wayne State Research and Technology Park, which is also called Tech Town Detroit. It's connected to the universities. That's where all the entrepreneurs go to get help. So definitely your local incubators that are connected to universities or accelerators, great ways to network. And then also local events, any local events in your city for founders to network and funders to connect you. You need to find out about those events as well.
Okay. Alex?
Yeah, I'd say I'd start with the Angel Capital Association because they'll have a list of angel groups all over the country. And then it's, network.
Yeah. Warm introductions. Yeah.
Yeah.
Yep. Yaniv?
So yeah, absolutely. I think the Angel Capital Association has a great list of all of the organizations that are part of their network. So that's a great place to start. Your professional advisors, your accountants and lawyers should help you find your local, investors, even though we invest worldwide, so it's not always just local. Go to events for your industry. There are usually places where you matches between investors and entrepreneurs. We prefer not to have a warm introduction. We wanted to democratize the application process, and we tell people to go to the website and just apply. But we try to make ourselves known through events like this and other events. So, the investors who want to invest, obviously, they want to be heard and found. So see where they can be found.
Great point. Great point. Yeah, both sides are looking for the other. Yeah, that's terrific. All right. Well, we are just about out of time. What's one key takeaway that every founder on the webinar today should remember or take away from your perspective as an angel investor? Alex.
It's a long journey. It's worth it. Don't get discouraged. Fundraising will take longer than you expect. And don't get discouraged by a no. I mean, the story is the founder of Chewy, which is now a multi-billion-dollar listed company, received 63 no's before he got his first investor. So hang in there.
Yeah. I think Uber was in the 60 to 70, or Airbnb was in that same neck of the woods too. So yeah, maybe that's the number. Yeah, go talk to 70 investors and then wait for your next one. So Brittni, how about you?
I would say educate yourself as much as possible. So attending webinars like this so you can understand the mind of angel investors and be better prepared, especially if you're underrepresented or person of color. We receive the lowest amount of this type of capital. So we really need to educate ourselves as much as possible so that when we're ready to approach angel investors, we're better prepared. Great.
Yaniv?
Yeah, I think that you have to remember when you present to angel investors, we have a lot of people, a lot of our investments obviously are based on science, and we have all of these wonderful entrepreneurs who just want to talk to us about the science. But we're in here in trying to invest in order to make a return on our investment. So when you make a presentation, when you come to speak to investors, think about the investor perspective. Think about the exit and work your way backwards. Tell us what's in it for us. Tell us why we're going to be, we're going to make a lot of money with you. Tell us how you're going to make us successful and how you are the person to do that, and then we'll be happy to come on board for that journey.
Great. And I'll leave with one notion that we use in our accelerator, which is, you're actually building, founders, two products, whether you know it or not. Product number one is the product you sell to your customers, and product number two is that share of stock that you're going to sell to an investor. And that share of stock has features and benefits just like your product does. And you need to be thinking about what those features and benefits are from the outset so that you can build a kick-ass business and have a kick-ass fundraising process. All right, Michelle, over to you.
Awesome. Thank you all so much for joining us. This was such an amazing conversation. Love all the different perspectives. And thank you for just giving such an amazing, clear overview on behalf of the entire NASDAQ Entrepreneurial Center and everyone in attendance today. We are very thankful to have had you join us.
Great. Thanks, everyone. Good to see you.
And to our audience, we would love for you to join us again for upcoming webinars, which you can view by using the links that are going to be posted in the chat. And thank you all so much for joining us today. We look forward to welcoming you back online with us soon.